This is a market review for the stock market activities on Friday, June 26, and a lookout for the week to come. We will start by looking at headlines that develop from Friday and since then, and then we're going to look at market activities during the day and trades that we've made, and then we're going to take a look at what to look for next week. Friday was a bad day for the market. It was pretty much a red storm from the beginning all the way to the end, and the reason is, or at least the reason they attribute it to, is the rising number of COVID-19 infections in Texas and Arizona, but particularly in Florida. So let's take a look at the cases in Florida. This is from Johns Hopkins, and the last 2 days you can see that the light orange columns right here. We've reported almost 10,000 cases today and over 9,000 cases yesterday. So cases are increasing rapidly in Florida. You can see a correlation. These green dotted lines are opening decisions in the state, and you can see that right after openings cases started to skyrocket. So there is a correlation there that you can attribute to the rising number of cases in Florida. I'd like to remind you of what Florida's Governor Ron DeSantis said about 6 weeks ago when he scolded reporters who outlined the danger or the dangers of reopening Florida.
Our data is available. Our data is transparent. In fact, Dr. Birx has talked multiple times about how Florida has the absolute best data. So any insinuation otherwise is just typical partisan narrative trying to be spun. And part of the reason is that because you got a lot of people in your profession who waxed poetically for weeks and weeks about how Florida was going to be just like New York. Wait 2 weeks, Florida's going to be next. Just like Italy, wait 2 weeks. Well, hell, we're 8 weeks away from that, and it hasn't happened. Not only do we have a lower death rate, well, we have way lower deaths generally, we have a lower death rate than the Acela Corridor, D.C., everyone up there. We have a lower death rate than the Midwest, Illinois, Michigan, Indiana, Ohio. But even in our region, Louisiana, Mississippi, Alabama, Georgia, Florida has the lower death rate. And I was the #1 landing spot from tens of thousands of people leaving the #1 hot zone in the world to come to my state. So we've succeeded, and I think that people just don't want to recognize it because it challenges their narrative, it challenges their assumption, so they got to try to find a boogeyman. Maybe it's that there are black helicopters circling the Department of Health. If you believe that, I got a bridge in Brooklyn I'd like to sell you.
Last question.
So obviously this guy is going to have a short political career because you just can't survive with this video circling over the internet. His stupid remarks are now haunting him badly. Back at the Johns Hopkins chart, you can see the rising number of cases here, and I can say by looking at the data from New York that this is attributed to the first phase of reopening here. It took a few weeks for it to show up. Now we have 2 more phases of openings right here, and these will start to show up later. So we're just beginning to see the number of cases increasing. It's going to get worse. The outlook for Florida is pretty abysmal. And let's take a look at which state in the country has the largest population of 65 and older. This is from PRB, and when we scroll to Florida, whoops, it's 20.5% of 65 plus older population. So apparently the older people who moved from New York to Florida to save on taxes and retire, they're probably going to die early over there because a bunch of spoiled young brats couldn't hold off going to the bars in the middle of a pandemic. And while we're showing you the stupid remarks from Ron DeSantis, the governor of Florida, obviously you don't declare victory on an unknown enemy, but here's a reminder of economic advisor to the White House, Larry Kudlow, what he said on February 25th.
We have contained this. I won't say airtight, but pretty close to airtight. We've done a good job in the United States. Hats off to our public health people. And the other generic point, and I hope we'll explore this, Kelly, is simply this. This is a human tragedy. There's no question, particularly in China. Human tragedy with, thousands of deaths. God look over them. Terrible. And that's the worst part of this. The business side and the economic side, I don't think it's going to be an economic tragedy.
Obviously, the credibility of Larry Kudlow has taken a big hit in the last few years because everything he says and everything he predicts is just pure propaganda and cannot be taken seriously at all. Here's another headline about the health of the economy overall. Car sales are down 30% in June. So here's another indicator that pokes another hole into that V-shaped recovery theory. Another one, the airline unions warned the government that there will be more furloughs, more firing, and job losses to come. And here we see Delta also warning that over 2,500 pilot jobs are in danger. So the airline industry is starting to break and collapse as we speak. We also had more data come out from the Fed about consumer savings, and consumer savings is at all-time highs. But when you look at the debt, it is also the highest we've seen since the financial crisis in 07, 08. So there's a correlation here that we have higher debt, but we also have higher savings rate among consumers. The big question is, will these savings, high rates of savings, be unleashed at some point as consumption in the economy to stimulate the economy after reopening? Or is it going to go to the stock market or other investments and inflate those markets higher? Or whether it's going to go to paying down debt. And that would show more fearful attitude from consumers out there. We actually have data about delinquencies, and we're seeing rising number of delinquencies on loans. So that's another sign of a danger to the economy and the consumer spending power. Even large public companies like Blackstone is now more than 30 days delinquent on their debt for real estate businesses. So you're seeing more consumer delinquencies and more corporate delinquencies on debt. This is certainly not a good outlook for the economy, and certainly more and more holes into the V-shaped recovery theory. Let's also talk about the Fed stress result from last Thursday. Of course, we've seen in the morning that Thursday the reversal of the Volcker rule, which is the most important rule that kept banks from gambling and creating another financial crisis. And now they're easing the Volcker rule regulations, opening up more dangers for the economy overall. At first, I thought that easing the Volcker rule was a decision based on pressure from those banks on financial regulators and the Fed, because that was their dream come true, is the elimination of the Volcker rule. They tried so hard to lobby against it during the Obama administration, and the Obama administration refused to budge. They got excited when Trump got elected. They tried to convince the Trump administration to get rid of the Volcker rule, and they failed because the Volcker rule is very sacred. Eliminating or easing the Volcker rule is economic blasphemy. But now it's happening. And at first I thought that it's a result of a pressure because the banks are using COVID crisis as an excuse to roll down those regulations. But now I'm thinking it is done because of a necessity, because of weaker financial data in the banks. The Fed did the stress test. They did not release the full results on which banks specifically, but they certainly saw something of a big warning signal there to cap banks' dividends and to have them resubmit the payout plans. That's for a reason. That's because they see something danger there. There's a dangerous situation going on in the banks. And this is the reason why they eased the Volcker rule, because it was done out of necessity to save the banks, the last attempt to save the banks. That's the way I see it, at least. Remember, to begin with, the Fed's formula of stress results remains secret. Nobody knows how they do it. We know that for the last test result on Thursday, they did a V-shaped scenario, a W scenario, and another U scenario, and that's it. But we don't get the formulas of what they actually do to conduct those stress tests. Here's a clip from David Serrata, who's an advisor to Bernie Sanders' campaign, or at least was an advisor, but he's been on top of this issue for a long time. This is from Rising program from The Hill.
A struggle or crisis in your own household, one of the worst ideas would be to go to a casino and try to big bet your way back to solvency. And what the situation that we're heading into now, this gives banks more leeway to go do essentially that, to go try to big bet their way into bigger profits or big bet their way out of big problems. And look, that's exactly what, as you said, that's exactly what the Volcker rule and the regulations after the financial crisis were designed to discourage.
And this is an amazing way to put it, certainly way better than I would have put it. When you're in debt and when you're in a big financial hole, is it a smart decision to go out to the casino and gamble and take a shot with whatever you have? Say, all right, well, I have thousands of dollars in debt, so I have a few $100s left in my pocket. I'm going to go gamble it in Vegas or any casino, and I'm going to make those thousands and pay my debt. That's a fool's errand. The probabilities are so slim. More likely is you're going to lose your money and you dig yourself deeper in the hole. That's what the banks are doing right now. They have problems with delinquencies. They're going to lose a lot of money on the loans that they have to restructure now. So their solution is, let's ease the Volcker rule and gamble with the money that was supposed to be saved as capital reserve requirement. And let's engage in casino hedge fund-like activities and take a shot and see if we can create more revenue and more profit. This is very dangerous, that the banks, the largest banks in America, are gambling to cover their asses. And I reiterate, why is the Fed hiding the details of the test result? Why are they hiding the individual bank names, the results for the individual bank names? Why are they kept secret? Is there something there that they don't want us to know? For example, Wells Fargo might be on the brink of collapse. Could be. It could be. Friday's market sell-off was largely attributed, by the media at least, to the rising number of COVID-19 cases in the United States. I don't see it that way, because we had larger numbers going on for a month now, and we had larger amount of death in New York, and the market didn't give a damn about it. It just kept going up and up and up. And remember in February when we were talking about rising cases in China and the spread globally, the market didn't care. The market does not care about COVID-19 cases or death, unfortunately. It cares about one thing, the economic impact. If there are more shutdowns, the market will react badly. If there are no shutdowns, even if there are rising number of cases and death, the market will just continue to go up because of Fed liquidity. So I see the market downturn on Friday attributed more to the abysmal results from Nike on Thursday. They've released the results, and every analyst out there in Wall Street was expecting very good results. And Nike comes out and say, no, we lost $790 million this quarter. And we have raised an insane amount of debt compared to the same quarter a year ago. I also attribute the downturn, of course, on the stress results from the Fed. The fact that they kept the results secret for the individual names and capped the dividends shows you that there's something really bad brewing in the banks. And with uncertainty hitting the market, investors will hit the sell button and ask questions later. Before we dive into the chart for Friday's activity, let me remind you of what I said on my conclusion of the video that I made on Thursday, June 25th. And I see the pops in the market like today as opportunities to sell and take profit and in certain cases to short. And as I expected, the pop from Thursday in the market was an opportunity to sell and short, and you've seen what happened during the market on Friday. Here's another reminder of what I said on June 15th about the airline industry specifically, and the cruises and the hotels and the casinos. Conclusion: we remain cautious, we remain bearish, and we continue to buy the VIX to protect our long portfolio, and we continue to short the rip in airline stocks and weaker stocks that are being pushed by day trading or gambling activities. These names are weak, they have no merit to go up, and when you see it, when you look at the real charts in the economy and the recovery, specifically for the airlines, hotels, cruises, they don't look good. So we continue to short the rip in these weak names. And of course, since then, you've seen a steep sell in these industries, and if you shorted like I suggested, you would have made a lot of profits by now. Another reminder, what I said about the VIX, the volatility index, on June 23rd, the volatility index, and I've been maintaining the position that until unless we close below this gap and we crack the blue line where the volatility index goes to its normal range, I'm still buying the dips on the VIX. I'm still buying the dips. Even though it was a big down day for the VIX in the morning, it's actually trending positive in the aftermarket right now. Because I explained to you and I maintain the position that once we have a big pop on the VIX, historically speaking, every time a big pop, a cool off, and a gathering of energy for a secondary move to the upside. And the move we're having right now is just too small to complement this large move that we had. This is probably a pop, consolidation, and another pop. And here's the update, a daily chart on the VIX from Friday. You've seen that since then the VIX popped higher, and it's probably hitting even higher to challenge the breakdown candle that it had here, the top candle, around 44 on the VIX. Let's take a look at another indicator here, the dollar index. We've talked about the breakdown here a few days ago, that it was a sign of a reversal in the dollar index and a good sign for the stock market. However, this candle here was inconclusive, and we said, hey, if this is a dip to be bought in the dollar, that will bring more pain to the stock market because investors are raising cash. And what do you know, we started popping out on the dollar index, and from the look of it, it looks like a breakout about to happen in the dollar index. Here's a look at the market activities during the day from a 15 minutes chart perspective. The day started selling off from this red candle right here, continued to sell off for the remainder of the hour and the next hour, and then I put a tweet that we will see a bounce off the lows by lunchtime because of short covering, and we saw that bounce right here before we started selling off. The buyers come in and selling off again and again toward the end of the day. There is a big candle here, green candle, before the end of the day, and that was short covering. If you were watching minute by minute, it was a huge pop to the upside. That was short covering before it reversed by more shorts and more sellers jumping on the trade. Obviously, it was a crushing defeat day for the dip buyers because they attempted to buy the dips and they just kept getting crushed. The Qs had a similar look at the SPY. It's the same thing. It's a breakdown. The selling in the technology sector and the big names like Apple and Microsoft were severe at the end of the day. Also, Facebook was down big based on boycotts, news, and all of that, so it contributed heavily in skewing the Qs to the downside. Let's take an update on trades we had this week. So if you remember, I opened a trade on Apple earlier this week. It was a bearish bet. It was a put for the 350 for next week, expiring next week, and I bought that for $185 per contract. But I sold the 347.5 put expiring last Friday, and I sold that for $1 per option, which means $100 per contract. So all in all, my entry cost was $85 for the trade, and I closed the leg expiring next week on Friday before the market closed. I closed it for $440, and the leg that was expiring Friday for the 347.5 expired worthless. So all in all, I cashed in $440 from an entry cost of $85, and that equals to 518% gain. Apple certainly could go down further for next week, but when you make a big profit like this, you don't want to be a greedy pig and take your chances. You take your profits, you go and you construct another trade if you see an opportunity next week. Here's an update on another trade for MGM. This put was purchased for $34 per contract. I turned it later on into a calendar put by selling the $16 put expiring last Friday, and I sold that for $30 per contract. Taking that in consideration, my entry cost for the trade got lowered to $4 per contract. However, MGM got whacked really hard on Friday, and the leg I sold to be expired worthless on Friday was actually in the money. So I had to buy it back, and I bought it back for $29 per contract. So all in all, I netted $1 per contract. In this case, I had 5 contracts, so I netted $5 from selling and buying back that leg that expired on Friday. I also sold the leg expiring next week on MGM, and I sold it for $96 per contract. So when you make the calculation, all in all, my entry cost was $33 per contract, and I sold the leg expiring next week for $96. So all in all, my profit was about 291%. MGM could have gone more to the downside next week, but again, you don't want to be a greedy pig. Let's take a look at a losing trade we had on Spotify. Shorting Spotify, which had huge gains in the last month. Bought a put contract expiring next week for $295, and I had to sell it at a loss for $220. So we have lost $75 on the trade. That's equal to 25% loss. Here's the lesson from this. As the market was going down, Spotify went down as well, but it got bought during the day, and I think it finished on the green. That told me immediately that Spotify is not ready to break down. There's still an appetite to buy the dip. So I was wrong, and I had to close the trade at a loss, but I minimized my loss to 25%. The lesson is, know when you're wrong, take your pride and swallow it, and close a trade that you know is going to be a losing trade, instead of digging yourself deeper in the hole. So what do we see for next week? This is a weekly chart for the SPY index. And you see these long triangle boxes right here. These are the weeks of the 4th of July week's performance for the last 4 years. And you can see there's a historic bias that the trading week of the 4th of July is biased to the upside. Nobody wants to upset America on her birthday. And certainly traders, they have shorter week because everybody's traveling or have plans with family, so they're not really investing in heavy trades before the 4th of July weekend. So the bias is to the upside. So this is what we expect. Let's say that the market opens down on Monday. That would be an opportunity to cover your shorts. If you haven't covered yet, take profits. And it would be also an opportunity to buy a little bit. You don't have to take any risks. Certainly, I might not make any trades for the week. I don't have to. But if you have to, you might see buying the dip opportunity in names like Facebook and Apple and Microsoft. But here's what I see. Let's say we open down on the SPY on Monday. I see a little bit of buying, not significantly, but I see the week ending in the green. So we'll look at opportunities one day at a time. I'm not in a rush to open any positions, but know that the week of the 4th of July has an upside bias. historically. That's all for now, and if you found this video helpful, please subscribe, share, like, and don't forget to follow me on Twitter.